A very good evening to you all, friends. I'm Sanjeev Singhal, Central Council Member and Chairman, Auditing and Assurance Standard Board. On my behalf and on behalf of my Vice Chairman, C. Vishalbhai Doshi, I welcome you to this 109th program of AASB for this council year. And today's topic is very, very important. It is audit of the internal financial controls. And friends, we know that the ICFR was adopted in India, and this is a concept which is parallel to SOX in US. And ICFR holds a very, very important role in the duties of an auditor. When he's doing audit of a particular company to whom the ICFR is applicable, he is required to undergo, to test those internal controls, the risk control metrics, the what can go wrong, and the mitigating controls. And it forms the bedrock, because if the controls are effective, then the extent of checking can actually go down. So it's a very important aspect of the overall auditing process. And with us, we have today a very esteemed keynote address personality, CA Rajendra Kumar P, who is the chairman of the Internal Audit Standard Board of the Institute of Chartered Accountant of India. Now it's been renamed to include, actually to expand its scope. And we are also working together on the internal control metrics for the sustainability aspect, because sustainability reporting has also been mandated in India from last year by SEBI. And from this year, a reasonable assurance of ESG information is also mandated for top 150 countries. And we are also very thankful to Sonipat branch led by the chairman Varun Vats for hosting this program. And of course, our very esteemed speaker, CA Yogesh Gupta, who is a very esteemed member of the Institute of Chartered Accountant of India and a partner with SS Kotari Mehta companies here, who will be the speaker. So it's indeed a matter of great pleasure that Sonipat branch Internal Audit Standard Board led by Rajendra Kumarji and AASB is coming together to enlighten the members on this very important aspect. And friends, let me also tell you that we already have an expert helpline, which is running since 16th of April, wherein by we are addressing the queries of the statutory auditor on auditing relating aspect. And this helpline will run up to 30th September. Please feel free to make best use of it. If you have any query pertaining to audit, use it. And AASB has also come out with the checklist on the auditing standard and also on the working paper templates. Please make use of it in the manner in which you feel appropriate. With this, I now have the pleasure of inviting our the man for the moment, C. Rajendra Kumar P, who was very, very passionate about whatever he does. Last year, the way he has led the GST education among the GST officers across India, he has traveled to the length and breadth of the country and overseas as well. And this year is putting a lot of efforts in the Internal Audit Standard Board. And I'm sure that the board will flourish as the GST committee of the institute flourished. Is already working very hard on issuing the internal audit standard on the areas which are remaining, and I'm sure that very soon they will see the light of the day. So with this, I invite C. Rajendra Kumar P for his keynote address. Over to you, R.K. Bhai.
Thank you, Dr. Sanjeev Singhal ji, very honorable Central Council member and chairman of this board. Really sincere thanks to you for inviting me to this forum. And I'm conscious that you are very tied up in your meeting with the president at the institute right now. So I would not waste your time, sir. I would certainly request you to please leave and attend to that important engagement which you are currently.
Thank
you.
So
I'll be here and I'll interact with the members also. Thank you so much. Very esteemed members who are here attending this particular 109th program of the Auditing and Assurance Standard Board. Yogesh Gupta ji is here. We have CA Varun Vats, the chairman of the Sonipat branch of NIRC of ICAI, and we have the secretary to the board also here. In fact, friends, auditing is the key of our profession. In fact, if you look at the charter or look at the preamble of the ICAI Act, the regulatory function of the chartered accountants is placed with the ICAI. And what is it that the chartered accountants are known for? Audit. Anything relating to tax and all those got added on a secondary level only. Primarily, we are auditors. Primarily, we are those who verify, who trust, who check, and who approve. many times I hear from the profession that auditing is becoming difficult, statutory audit is becoming difficult, so many responsibilities are placed. But then if we travel in history, I think the profession of auditing has developed far and wide. And with the new changes that are being launched on a daily basis, or maybe new tools that are coming on daily basis, I mean, it does not make things very difficult for us, but then certainly an eye for the knowledge, the eye for the detail is required. And friends, if you know the world of auditing, which was there since the days of Chanakya and what we are today, I don't think the principle has changed. The principle is trust but verify. Very esteemed Yogesh Gupta ji is here. I mean, internal financial controls. In fact, that is what he's going to deal with today. If the internal financial controls are proper, they are set, then nothing to worry. Nothing to worry. In fact, things go wrong when the internal financial controls do not adhere to the standards that have been laid down, deviate a little bit here and there for the benefit of whomsoever it is. So audit of internal financial controls is extremely important. And we have people like Yogesh Gupta ji who is going to handle this for us today. Sir, I welcome you to this forum. I sincerely thank you for sparing your valuable time. I know, sir, as a speaker also, I know if you have to speak for about 2 hours, you need to prepare for 6 hours. I know that. And we are also terrible people in the institute. We give you only 2 hours CP credit, knowing fully well that you would have prepared for 6 hours. That's what happens, sir. But then, yes, each day we learn, and as we speak, as you prepare, new things come up in our mind. Sir, thank you very much for sparing our valuable time. And Varun Watts, chairman of Sonipat branch, today Institute's position is not what as it used to be 2 decades or 3 decades ago. Today it's a 24/7, 365 days position that you hold. You're a very young person. Thank you very much for leading this one of the arms of the institute.
Thank you, sir.
See, it is a thankless job. No one is going to thank you. Exactly. No one is going to praise you. Or everyone is going to find fault somewhere here or the other. But then, at the end of the day, it's a satisfaction that you get that yes, I have done something for my alma mater, something for this institute, something for the branch, and something for the members, and you get noticed for that. Sincere thanks to you for sparing your time also. Thank you very much, and over to you. Thank
you. Thank you, Rajendra Kumar ji, our Central Council member and Chairman of Internal Audit and Management Accounting Board. CA Sanjeev Singhal ji, CA Dr. Sanjeev Singhal, Central Council member and Chairman of Auditing and Assurance Board. I am here today. I am honored to be here today as the moderator of this session. Myself, CA Varun Watts, the chairman of Sonipat branch of NIRC of ICI. Today, CA Yogesh Gupta ji is here, our guest speaker for the day, on the topic of audit consideration on internal financial controls. We are honored to have such a distinguished speaker on the topic. I am thankful to CA Yogesh Gupta ji, who have generously agreed to share his expertise with all of us. CA Yogesh Gupta ji has been in practice for over 2 decades. He has been engaged in audits of large and medium listed company and other clients in manufacturing, services, BFSI sectors, covering vast pool of industries in the capacity of statutory auditor, internal auditor, management auditor, etc. He has served AASB, Accounting Standard Board, and Ind AS and expert advisory committees in earlier years as special invitee member. He has also served as a faculty for Ind AS certification courses carried out by ICI. He was member of Delhi study group for bringing out implementation guide on audit of internal financial controls over financial reporting with specific reference to smaller, less complex companies. So friends, let's take advantage of this expertise and this opportunity to grow. Let's begin this journey of learning and discovery together. Thank to all of you for being here. I will welcome CA Yogesh Gupta ji again to kindly take the session further and help us enhancing our knowledge on the topic consideration for internal financial control. Thank you, sir.
Thank you so much, Varunji. At the outset, I must thank our CA Dr. Sanjeev ji, Chairman Auditing and Assurance Standard Board, for providing me an opportunity to take session on audit considerations on internal financial control. That is one of the most, I must say, lively topic. Although this topic is not a new one, but it has its everlasting impact. As CA Rajendra Saab, our Central Council member, has just mentioned that IFC is one of the backbone of the entire auditing profession. And auditing is the backbone of CA profession. That's what I understand, and I also believe the same, breadth and the length of the subject. So this topic is not a new, however, it's an everlasting impact on the audit of financial statements, big, large, small, medium, any kind of organizations, non-profit, profit-making, or otherwise. I also thank Chairman Board of Internal Audit and M&A Accounting, CA Rajendra Kumar ji, Central Council member, for sparing his valuable time for this webinar. Sir, thank you so much. I thank Chairman Sonipat Branch of NISC of ICI, CA Varun Basri, for being moderator of this session. Thank you so much, Varunji. Your guidance will be, we will be able to enhance the subject, in terms of your guidance. And I also thank Vice Chairman of WSB Board, CA Vishal Doshi ji, for making this all happen as such. I must compliment WSB. I just came to know that it's 109th, webinar / seminar, which WSB board has, embarked upon. So WSB has been taking many sessions, giving a lot of trainings to members, particularly in practice. And I must say that it provides a refresher capsule knowledge to members in practice on a regular basis. And I was told that this topic on IFC, in the last 2 years, it has been taken multiple times. So it is the endeavor of the WSB to take this topic on a regular interval, maybe 4-5 months interval, so that a new perspective can emerge out and members are thrust upon with the need and the importance, significance of this topic. So thank you so much. Can we start the formal presentation? Varunji,
Yes.
if you kindly consent to it. Thank you so much. So I hope the screen is visible.
Yes, sir.
It is visible, sir.
So audit consideration on internal financial controls. Good evening, all the members of the institute and other distinguished people who are there on this webinar at this moment. I am CA Yogesh Gupta, practicing chartered accountant. The flow of presentation which I have taken, I just enumerate over here as this. Key concept of IFC, regulatory perspective, that's very important, and significance, step for auditing IFC for financial reporting, type of audit reports on IFC, bearing of IFC report on main audit report, because auditors is required to present 2 audit reports, one for the true and fairness on the state of affairs of the financial statements, and another one on the internal financial controls perspective. So is there any bearing on the IFC report on the main audit report? That we will be deliberating in this today's webinar. And then we have taken the extracts of few public listed companies IFC reports, as well as the corresponding main audit reports. What is the replica and what is the impact on the main audit report if there are any qualifications, modifications, or adverse opinion given by the IFC auditor. Then applicability of IFC with respect to reporting, standalone, consolidated, whether it is all the entities in the consolidation will be affected, will be called for the reporting, or only entities which are only operating out of India. Then approach to audit, whether integrated approach or distinct with respect to audit of financial statements and reporting of IFC. IFC, internal audit, and CARO, kind of comparison, similarities, and distinctions. Approach to audit of IFC for companies having relatively smaller, less complex operations. Implementation guide issued by WSB of ICI. And key takeaways. I must mention over here that I was engaged in 2015 and / 2016 beginning under the convenership of CA Harinderjit Singh ji, who was a technical senior most technical person in Pricewaterhouse, and we together with many more members, have taken up the task of giving a kind of frequently asked question format on the IFC matters, covering the smaller, less complex operations. So that is the task we have taken, and the institute has come out in 2016, mid 2016, a kind of implementation guide on this subject. This implementation guide was after the complete, I must say, IFC guidance note, which has been published in 2015, guidance note on audit of internal financial control over financial reporting. So I will be covering some few points as to whether there is any difference in terms of auditing of IFC in a smaller organizations, less complex, having less complex operations. So starting the key concept of IFC. As per section 134 of the Companies Act 2013, before 2013, this IFC concept was not there in Indian Companies Act. So when the new Companies Act 2013 was implemented, came into practice, then this section 134 of the Companies Act states that Companies Act, section 134 included the IFC. The term as per section 134 of the Companies Act means the policies and procedures adopted by the company for ensuring the orderly and efficient conduct of its business, including adherence to company's policies, safeguarding of its assets, prevention and detection of fraud and errors, accuracy and completeness of the accounting records, and timely preparation of reliable financial information. At one section, the entire gamut of accounting procedures, the policies, the procedures, and other aspects with respect to safeguarding of assets, prevention and detection of fraud, the hygiene segment of the accounting records, and the timely preparation of the information, financial information, was put together, and this responsibility was cast on the board of directors to ensure that the board of directors must adhere to this section, internal financial controls. Now, the Institute of Chartered Accountants, as soon as this guidance note has come out with the guidance note in 2015, because earlier this section 134 is applicable on the companies. So from the company side, they were the board of directors and its operating management was required to formulate the policies and procedures with respect to the internal financial control, which they have defined in the section. In 2015, the Institute of Chartered Accountants of India has come out with a detailed guidance note. So as per the guidance note, a process designed to provide reasonable assurance regarding reliability of financial reporting and preparation of financial statement for external purposes in accordance with generally accepted accounting principles known as GAAP. A company's internal financial control over financial reporting includes those policies and procedures that pertain to maintenance of records that in reasonable detail accurately and fairly reflect the transactions and dispositions of the assets of the company. So what this IFC guidance note has come out with, this section of 134 is applicable on the company with respect to financial transaction as well as other than operating transactions, operating controls. So the financial controls, or I would say the internal controls over the financial reporting and financial transactions, as well as the internal control over the operations of the management with respect to human resource, with respect to production, with respect to quality control, with respect to the credentials of the suppliers, credentials of the customers, and so on and so forth. So the company has been mandated to take care the implementation of the policies and procedures in a broad manner, taking the financial subject as well as the operations controls. However, the guidance note on the of the ICI, has cast upon the duty as per the sections, of the Companies Act. I will later on mention in section 143 of the Companies Act, which cast duty on the auditors to report on the IFC. So it says IFC on the financial transactions, on the financial reporting. So this guidance note is covering mainly the financial reporting portion of the company's complete sets of operations and controls. So it says that the policies and procedures that pertain to maintenance of records that in reasonable detail, accurately and fairly reflect the transactions and dispositions of the assets of the company, provide reasonable assurance that transactions are recorded as necessary to permit preparations of financial statements in accordance with the GAAP, and the receipts and expenditure of the company are being made only in accordance with the authorizations of the management and directors of the company. There is a difference between the transaction which is reported and the way the transaction should have been reported in terms of whether it is properly authorized, whether it is for the company, whether there is no personal expenses which is charged to the company. So each and every process and the policies which encompasses the financial transactions, the company, the auditor has to give a reasonable assurance to the external stakeholders and the shareholders of the company that all those transactions are passing through a proper system of checks and balances, authorizations, and there is no unauthorized transactions which are taking place, which are material in nature. So that's how it says transactions are recorded as necessary to permit preparation of financial statement in accordance with GAAP, and receipts and expenditure of the company are being made only in accordance with authorizations of the management and directors of the company. It also says provide reasonable assurance regarding prevention or timely detection of unauthorized acquisition, use or disposition of the company's assets that could have material effect on the financial statement. So not only the transactions, but the physical use, the disposition, the sale of the company's asset, unauthorized sale of company's assets, unauthorized acquisition should also be routed through, should also be checked and reported. So if I just sum up the regulatory perspective, section 134 says director responsibility statement. In case of listed companies, director responsibility statement must state that company has followed internal financial controls and such controls are adequate and operating effectively. So there is no IFC on FR. Directors are bound to confirm and adhere to the IFC in totality, taking the operational part of the controls also. Whereas in the auditor's report, the auditor is required to state whether the company has adequate internal financial control systems with reference to financial statements in place and the operating effectiveness of such control. So there are two aspects to IFC. If I just say it is the design level of the control, whether the control have been designed, which should have been designed, and then if they are designed, then whether they are operating effectively or not. So both the perspective, the auditor is required to report of the transactions, of the processes which are of the financial nature as such. Section 177 of the Companies Act, casts duty on the audit committee that audit committee may call for comments of auditors on internal control system before their submission to the board and may discuss any related issues with the internal and statutory auditors and the management of the company. Schedule 4, which talks of independent directors, it says that they have to ensure that financial controls and systems of risk management are robust and defensive. And then there is a rule which of the company's accounts record rules, which says that adequacy of internal financial control with reference to financial statements, that is the board report, has to have a specific paragraph covering the adequacy of the internal financial controls, wherein the board informs to the stakeholders that all the financial controls, internal financial controls are effective, they are designed properly, and they are effectively. So I will say the IFC covers the entire gamut of activities as well as the all stakeholders, whether it is from the management perspective, whether it is from the independent directors perspective, whether it is with respect to CFO, CEO certification perspective, whether it is respect to the auditors, and whether it is respect to the audit committee. So all these stakeholders or all the people who have the responsibility to ensure the adequacy of financial control within an organization, whether they are the part of the management or they are the part of the oversight board, like the auditors and the independent directors. Each and every segment of the activities of the people have been given the specific responsibility to carry out their part of the work and then to report accordingly. Question arises why? Now this IFC, as the Internal Audit Standard Board Central Council member Sri Rajendra Kumar ji rightly mentioned, that if IFC is robust in a company, in an organization, then there are fair chances that the financial statement which are presented to the stakeholders would also be in the same manner as such. So if, or conversely, if the control systems are not adequately designed, or if they are designed, they are not operating effectively, then it is going to, or there are chances that there is a material misstatement which may happen and which remains unrecorded, undetected by the auditors or by the management. So it is the backbone of any financial statements, any financial system, any company. Hence, each of the stakeholders have been given due responsibilities to make sure that they carry out their job as per mandated provisions. So as I mentioned that internal financial control over financial reporting, it's a maintenance of financial record, authorization of transaction in accordance with the GAAP, generally accepted accounting principles, and safeguarding of assets of the company. That is IFC on FR. Then add together the operational control, it becomes the IFC, which is required to be mentioned by the board. Now, what are the steps for auditing IFC FR for financial reporting? I am limiting my presentation to the financial reporting aspect, so that is what is required for the auditors to look into. So, like SA 315, it has got 5 steps: planning, risk assessment, design, testing, and remediation of gaps, operating effectiveness testing, and overall reporting. So, whatever audit strategies with respect to IFC FR, an auditor has to follow. It must pass through a detailed planning, followed by a risk assessment, taking the chart of account approach, and design testing, as well as operating effectiveness testing, and then giving the report as a conclusion in the form of IFC report to the shareholder of the company. So internal financial control system needs to be dynamic to address the change in the entity's operating environment, including business development, including change in information technology. To this IFC has to be seen from the perspective not only from the processes but from the information technology, business processes, change in the key management, and the acquisition and mergers and divestment, legal and regulatory developments such as change in industry regulations and new regulatory reporting requirements, change in the financial reporting framework such as change in accounting records standards. So if I start from the planning perspective, that is the foremost activity in any audit engagement. Every audit engagement has to start from the planning after the client has been accepted, and the planning should take the maximum time of the audit department, auditors at the senior level, team, because if the planning is rightly done, then the execution would definitely, lead to a better conclusion, a better effectiveness. So in terms of planning, the understanding of the control environment and the knowledge of client business, that is the utmost importance. There are essays in the institute which has prescribed how knowledge of client business should be gathered and how to understand the control environment of a company, whether the company is highly regulated or it is, whether the company has got dependency on the total exports, total import, are the key management people changing very fast, whether the auditors are changing, so all those things have to be taken into consideration while assessing the control environment and understanding the control environment with respect to knowledge of client business. Defining level of materiality, taking into consideration quantitative approach such as revenue or profit. It could be X percentage of revenue or X percentage of profit before tax. Mapping of chart of accounts to identify significant accounts and relevant assertions based on level of materiality analysis. This is one of the most important subject. Normally, based on the practical experience, what we see that when the audit team goes to the audit, they have their own version of, saying it that, we'll check the purchases, sales, and all the functions which are generic in nature. But if you map the chart of accounts with those processes, it may be possible that few processes might have been added which are not generic in nature, but which would have a material significant transactions, financial transaction that cannot be overlooked. Similarly, there could be some non-recurring financial transaction might have taken place, maybe a sale of a major part of the assets of the company, booking of any loss in terms of any debtors, which is substantial and material in one time, or taking any exceptional item of expenses or income, or any of such nature assets. So it is very much important that the chart of account have to be mapped with the processes to find out and to know that the planning is not having any kind of impurity with respect to only the working based on the memory. So one has to very conscious that each of the chart of accounts having the material transactions must be mapped and must be taken into consideration for the purpose of identification of the transactions that needs a review from the IFC perspective. Then identification of the significant business processes and sub processes, linking and the business processes, performing qualitative assessment such as volume of an activity, complexity, nature of accounts and disclosures, and so on and so forth. So if the planning is correctly done, then followed by risk assessment. So understanding of each business functions to understand the broad activities mapped under each business functions along with the information system. One has to see that which are the activities which are routed through a ERP system, because nowadays most of the companies are having their ERP version, whether it is SAP or Oracle or Navision or maybe Tally, and activities are processed through a process of one person is doing and then another person is checking, and then that flow is moving to the next level and to next level and to next level. So rather than purchase department is segregated at one place, it is actually the activities are falling in such a place that more than purchase department people, there are many people who are involved in the process of the entire value chain of the that processes. So one has to see whether the business processes are mapped and they are being transactions are taking place based on some ERP package, or they are based on the standalone manual process. That is very, very important at that time, because risk assessment, if something is going through the ERP process, then the limitation, the checking of the item may be limited to checking of few items. But if it is a manual intervention, then one cannot rule out the mistake of non-deduction of any material misstatement, because manual transaction can take place, and you cannot say that one transaction you have checked, so then all other transaction will be having correct version. Whereas in case of ERP process driven, if one or two transactions are checked, then it gives a reasonable assurance that if the process is followed seamlessly without intervention of any I may say super user or any other authority, then the output will be same for all the transactions of that category. So that has to be seen very, very critically. Identification of the risk of material misstatement under each of the processes. Then existing controls in the business process, sub processes. Every company would have normally large company have a process of preparation of the detailed standard operating procedures, popularly known as SOPs, which were earlier known as kind of circulars or kind of IOMs in the traditional era. So now they have taken the shape of SOPs, which are defined, and they are process based carrying out of the business functions rather than a person based approach. So companies would have SOPs in place, and then each SOP is also bifurcated or segregated into risk control matrix. A risk control matrix define these are the risks in each of the business functions or each of the process and sub processes having the financial impact, and these risks would have a corresponding controls, whether those controls are automated either through IT system or these are the controls which are routed through manual system. So that has to be seen whether the company would have detailed SOPs and the RCMs, risk control matrices known as RCMs, and whether those SOPs and RCMs correspond to the chart of accounts risk of material item which has been identified based on the planning and the scoping document. So if SOPs are there but they are not covering few aspects of those chart of accounts item which have got a material or significant transaction, that process has to be I must say taken it out and then reviewed in detail, so that there is no ambiguity in terms of the any audit risk which remains undetected. And finally, the concurrence and validation of the management on the process document. After the assessment of risk, then the auditor is required to see whether the design is there or not. So in order to test the design of any transactions, of any process control activities, an auditor is required to see, and he can pick up one or two vouchers, and he can walk through the entire process, whether the design is there, whether the company has got a complete internal controls mechanism, the complete checks and balances are there in the system, that transactions are not having any kind of collision or any kind of, and each transaction is getting checked by a person which is independent of the maker of the transactions. So there is no one person who is having the complete control over the entire financial transaction, whether it is from the purchases. If the PR is being prepared by somebody is giving authorization for the purchase department for making the purchases, then the purchase department has its own functions of assessing where from these items have to be procured. Then they have to select the process of vendor selection process should take place. After selection of vendor selection process should take place, they should invite the bids, then the lowest quotation of bids assessment, and then the purchase order issuance. And then in the purchase order issuance also there are defined I may say limits, that up to this level the purchase order can be signed by X person. Beyond this level it has to be signed by one more person, and then after a limit it is signed by the senior management. So something of that sort, the things are defined. So the auditor is required to test of all the financial transactions, this design testing. I must say at this juncture that it is not the auditor who has to see this work and do this work from the scratch, because section 134 of the Companies Act says that it is the management which has to carry out a complete adherence to the IFC. So adherence to IFC has to be demonstrated by the management to the auditors, statutory auditors, that the management has carried out all those assessment of risk as well as the transactions, and each of the transactions which are starting from the chart of accounts, management has carried out its own management assessment, and they have done the design level testing and they have done the opening level testing. This is how the management should demonstrate to the auditor, and auditors is required to see the management testing as well as carry out its own testing in order to validate what the management assertions are, or if there are any large deviation from the management assertions, then auditor has to find out the reasons as to why there are variations, and whether it requires a kind of deep drill down in the system, and then further whether it requires a kind of reporting as part of the modified report in the auditor's report. So it is the management which has to do the first step. The board of directors have to oversee the entire perspective. The independent directors have to ensure that the management has the robust system, and then the auditors would come into play, who is going to see, evaluate the management assertions as well as carrying out his own assertions at a limited level. And the IFC guidance note which is issued by the ICAI in 2015 has also as a part of reference table given the kind of number of vouchers which can be tested by the statutory auditors and in order to make sure that he is not missing on any minimum number of things. At the same time, he is not doing overworking in terms of doing the IFCFR perspective review. So design level testing has to see whether the design of the various sanction is properly made or not, and if there is any design gap. Because if there is any design gap in any major financial transactions, it will lead to a kind of collapse in terms of operating effectiveness. Because if the design is not there, then how would anybody ensure that how it is being operated effectively? It means it is the people driven and not the process driven. So that aspect has to be seen. Then to this control deficiency, I have mentioned identification and remediation action. This is the output kind of one of the snapshot I have provided how an auditor can illustrate, can design, can make the sheet for the design level gap. Then after the design level gap, which auditor is required to see and ensure that there is no design level deficiencies in the IFC perspective of the company. Then whatever design is there, then he has to check the operating effectiveness. So now the number of samples to be tested are more in operating effectiveness, because that is the way through which the auditor finds a kind of complete assurance, a reasonable assurance that the transactions which are designed are also being managed, are also being operated effectively in the same manner as they have been designed. So that is one of the most important perspective which the auditor have to see. Objective is whether the control is operating as designed, and whether the person performing the control possesses the necessary authority and completeness to perform the control. So he has to take care of the sample strategies, he has to prepare the testing plan, testing of controls, remedial plans, and so on and so forth. The auditor is required to carry out all those steps which are mentioned in various standards of auditing of the ICAI in order to make sure that he does his planning properly, he does his risk assessment properly, then he is able to test the design level assessment as well as the operating effective level assessment access. So in terms of operating effectiveness, which are factors which may be relevant, could be inherent risk associated with the rated account. If it's a related party transaction, then auditor have to be very, very careful that, there is inherent risk that something may go wrong. So he has to put an extra cautiousness. Whether the account has a history of errors, the nature of controls and the frequency with which it operates, the degree to which the control relies on the effectiveness of other controls, the nature and level of materiality of misstatement that the control is intending to prevent or detect, whether control relies on performance by an individual or it's automated. So that's one of the most important subject is audit have to see if the process is automated. So unless and until somebody is gaming the system, somebody is doing unauthorized access, unauthorized transactions in the system which are not being which were not being seen from that naked process, then if the process is automated, then if he is able to test few samples, then it is bound to have the same results if the process is automated, which is not there in terms of if the process is manual. So he has to plan the nature, timing, and extent of the procedures, nature of the procedures. Then he has to cover which period to be covered. That is one of the major questions which is asked in the IFC reporting. Which period the testing should take place. Now, what happens that the IFC report is report on at the close of the year assets, which says that the auditor have gone through the process of internal financial control, which is designed by the management, and management is responsible for the effective discharge of a responsibility with respect to adherence of each and every processes. And auditor is required to comment on the operating effectiveness and the design effectiveness of the process. So auditor has to see not only at the fag end of the financial year, he has to see transaction, but he has to see transaction how the transactions are being carried out during the period. So he has to pick up a sample which is resemblance to the period to which he has to give an opinion, and not at the close of the year. Then the risk associated with the controls. At the risk associated with the controls increases, it may more likely that auditor will plan to test operating effectiveness without using roll forward procedures. When the auditor chooses to perform the test, the testing of the operating effectiveness of the controls generally is performed after the control has operated. If some controls are not designed, then the operating effectiveness may not be checked. So there are other measures through which auditor has to satisfy himself that although design is not there, but the transactions are being routed through in a process which are compliant to the gap and the internal controls mechanism. Then extent of procedures, I have mentioned that the institute, the guidance note also have defined a certain table which says number of transactions at each of the interval one can carry out. However, it is a judgment of the auditor. If he finds that he has to check more transactions than what is defined in the guidance note, he should definitely do that thing. And if he finds that his sample transactions are giving indications or results that is not compliant with the design level testing, then he has to increase his operating level of testing. So testing strategy needs to be documented also, because not only the auditor have to carry out these tests, but he has to also document these tests to demonstrate in his file that those procedures have been carried out by the auditor whenever they have been referenced to. So what to test? Test only the key controls. How to test? Inquiry, observation, examination, and the performance. When to test? Cover entire period with additional focus towards year end. How much to test? Number of samples, as I mentioned, and sampling strategy. These are all things needs to be seen. This is one of the template which I have just appended for the reference purpose. This is how an auditor can document the outcome of his test of controls, which is known as TOC, or test of design, which is known as TOD. So it may have the process description, the company name, the control description, the test steps, the sample size and period, the timing, frequency, occurrence, period from which to this date, and testing strategies, and then the result of the test. So in a complete IFC, I would say if one need to bifurcate into major heads, then one can say there are entry level control which has to be tested, and there are process level control which has to be tested. What are the entry level controls? Entry level controls are those controls which are all pervasive, irrespective of the process to which it applies. It applies to all the processes in an organization. They are generic in nature, and they set the tone of the top management. They set the tone of the organization with respect to the ethical requirement, ethical compliance, with respect to its whistleblower policy, with respect to its transparency, with respect to its process driven organization, and so on and so forth. So while doing the IFC testing for the purpose of giving a report in the audit report on IFC, the auditor may bifurcate all the test into entry level controls and the process level. Entry level controls also includes the control over IT system affecting the financial reporting, antivirus protection, disaster recovery planning, controls over directories and folders, and then there are process level controls. Process level controls basically are the controls which are for each function, like the purchases, the sales, revenue cycle, procurement, procure to pay, uh, uh, then receivables management, then payables management. Then they may happen that HR. So entry level controls, if are found to be failed or if are found to be design deficient, then that poses a larger risk to the auditor, and he has to see if he finds something unethical practice which is happening in the company. Fine. If you find there are many whistleblower, there is no whistleblower policy, or the whistleblower policy is there, and there are many complaints which are being received by the whistleblower secretariat, then he has a larger perspective to see whether the entire system and process within the organization is functioning properly or not. So it also includes the internal audit mechanism, whether the company has got an internal audit function which is independent, reporting to audit committee. Internal audit function may be in-house as well as it could be outsourced, but is it reporting to the audit committee? Number one, is it independent? Is internal audit department able to mention each and every findings without any fear, whether roles and responsibility of the senior management is defined and documented, and whether adequate safeguarding of duty exists. It also includes legal compliance framework, whether the legal compliance framework is documented and compliance has to be checked. When we have gone through top 1,000 listed companies report for the purpose of preparation of this presentation, and the team were working, so we could find out many companies who have flagged as part of their IFC report the legal non-compliance to many aspects, and that has got a replica findings in terms of the main audit report. So that legal compliance framework is very, very important, as the internal audit function or ethics and risk management policies. Then anti-fraud mechanism and management operational reviews, whether how the management carries out the oversight or the review mechanism happens in the company. So these are the entity level control which are normally being seen and reviewed based on the interview process, based on the discussion with senior management, based on the observations by the auditors while he is there assessed in the organization while doing the audit. Process level controls, as I mentioned you, process level controls normally are the business processes, like some of the listing I have made. Procurement, in case of a textile company, direct material, it could be fabric, yarn, knits, hosiery, accessories, chemicals. Procurement can take place of these items. Then supplier panel creation, price negotiation, contractual arrangement, material procurement planning, raising of purchase orders, approval and releasing of purchase order, approval and purchase orders and schedule, adding of new suppliers, and risk analysis and mitigation. You will find that many of these items are having operational control. Fine. And some of the items are having the financial control. The auditor has to see and has to report on the financial control. But in order to report on the financial control, the auditor has to see whether the entire process is defined in such a manner that the operational controls are also effective and they have been confirmed by the management, and auditors can rely on the management controls of the operation side, and then he can see the financial side of the control. Similarly, for the procurement of indirect material, procurement of other aspects, then logistics, I'm just mentioning some of the items which may be found out based on the chart of accounts. Chart of accounts of any company which is manufacturing, having manufacturing, would have a large item outlay in terms of the logistics. It could be inbound logistics, it could be outbound logistics. If the company is having major exports, a company of 5,000 crore rupees having exports to the extent of 50%, one will find there are many logistics, huge logistics expenses which are happening. It could be the export shipment, as well as the company may import some of the item. So logistics is also one of the major business segment, and this could be found out based on chart of account analysis, as I mentioned, which is very, very crucial at the planning stage itself, because unless and until the chart of account approach is taken, there are chances that any material item may be skipped from the perspective. Another item is treasury. Now, normally in a manufacturing or service organization, auditor may find that he see the generic processes within the organization, but treasury nowadays we find that the treasury, many companies are having surplus cash, so they have a dedicated treasury department, and there are very few people at senior management level who are handling the treasury department. And treasury department, in terms of the value of the items, sometimes in companies, if you see the companies and IT segment, treasury department is having a very treasury segment is having a very huge asset size as well as the income side of the financial numbers. So whether the treasury department is having defined SOPs where to put the fund of the company, whether to put the fund of the company based on the risk management of the company or not. So this treasury department is one of the important segment business process which has to be seen, that can also be found out based on the chart of account approach. Inventory management is normally found in every company of manufacturing setup. Then the production, hire to retire. Then there is a payroll mechanism, and not only payroll, the attendance process, the complete leave encashments and gratuity and contractual labor attendance, which is a huge outlay in companies which are backed up by a large number of people, whether they are on permanent role or they are taken on the contractual basis or a mix of both. So that is another business segment which has to be looked into from the process level controls perspective. Finance and accounts, nonetheless, is there assess accounts payable, cash management, bank, taxation, insurance, and other aspects. Then financial statement close process. That is a process which combine, consolidate, and then prepare the financial statement. This process completes the financial collation of financial information and then making the financials for the purpose of audit. So the financial statement close process is very, very important from the IFC FR perspective. Whether the subsidiary ledgers are tying up with the main ledgers, whether the balance sheet reclassification and classifications are properly carried out, transaction related party, whether they have been disclosed appropriately in line with the requirement of the regulatory aspect, whether the borrowing and accruals are properly done up with, whether the I would say cut-off procedures with respect to revenue recognition, with respect to recognition of any accrued income have been correctly measured and correctly reported. So this FSCP, which is financial statement close process, is a very, very important procedure, where segment which has to be looked into, and this may not get found out based on the chart of accounts, if a chart of account does not have, because these is not numbers which are on its own, they are collating the numbers of other business segments. Hence FSCP is to be seen by the statutory auditors for the purpose of taking care of the financial reporting on IFC on the financial part. Order to cash, this normally is found out in many companies and most of the companies. Order to cash, customer relationship, then account receivables, service agreements and contractual agreements and agreement with the contractors. Then fixed assets. That's another area which one may find from the chart of accounts, that in one particular year the company has done major outlay in terms of the capital expenditure, and it is being reported either as part of the CWIP or as part of the addition to fixed assets or addition to property, plant and equipment. So one has to see whether the proper budgets are there, capex approval process is there, because that's a huge outlay. And capex is also one of the item like treasury, which is actually with respect to its sanction, approval, and release of purchase orders. It is a senior management, which normally takes care of this function, because it is not a very routine functions in most of the companies. It's a non-routine it's not a recurring nature of item, which is when the companies goes for expansion, it doesn't go expansion every year normally. So this is an area which can be found out from the chart of accounts, and the auditor must see to it whether he has taken into consideration for the purpose of planning, for the purpose of assessment of risk, for the purpose of design level of testing, operating effectiveness testing, and then finding is issues with respect to any of those non-compliances or deficiency in the system. Then the role of IT. That's very, very important. IT general controls and the IT application controls. So IT general controls normally form part of the ELC, that's what we call entity level control. They are all pervasive and are applied in the entire company. They are more generic in nature. They are like organization and information technology environment, the control environment of the IT segment within an organization, and it represents the foundation of the IT control structure. They help ensure the reliability of data generated by IT system and support the assertions that system operate as intended and that output is reliable. They are basically pervasive controls, in absence of which it becomes impossible to have a strong control over the information system. Now, believe me, if an auditor finds that there is no password, sanctity, there is no password hygiene which is being maintained. People are giving generic IDs. People are giving password which are used by more than one person. For the same process, for different processes, for different generic IDs have been given, and ITGC controls major non-compliance is happening around. So it raises the entire question mark on the entire set of financial statements which are being prepared based on the ERP system or the IT-driven system. Then auditor, once auditor finds out that if there are many loopholes, there are many deficiencies in terms of the design level, as well as at the operating level of the ITGC system, then auditor may conclude based on the outcome of the ITGC review that whether he can rely on the entire system of ERP or not. And if not, then he has to take the substantive control mechanism or substantive control route to assess the risk of material misstatement which may get unnoticed. So that's very, very important from the ELC perspective. Now, some of the deficiencies in the ITGC review which the auditor may find out, the information security policies and procedures are not formally documented and approved by top management. Access to super user ID to many users, which may lead to misuse of this ID. What is super user ID? Normally, in an organization which is running through ERP systems, there are certain IDs which are known as super IDs, which are given to senior management, which can override the normal process which is designed by the company. So if a purchase requisition to purchase order to issuance of the proper of receipts and the payment of the suppliers is maintained by a flow of activities where the complete maker checker process is there, and there are many people who are specified to carry out the activity. But then there is a super user sitting at the level of CFO, and who can actually bypass and breach the entire system, and he can carry out any transactions through his super user ID. And if there are many super user IDs in the system and they are being used by those people for the purpose of daily routine transactions, that leads to a kind of conclusion. That may lead to a conclusion that the entire ERP system may not be fully reliable, and the super user IDs transactions requires a more detailed scrutiny from the auditors with respect to finding out whether the financial control system, which is designed and looks like very perfect, whether it is really perfect in terms of its operating effectiveness or not. So this one can find out based on the IDGC controls as well as application controls. Similarly, I mentioned that absence of password policies and weak password parameters. Then segregation of duty. This is more to do with the application control. I would say segregation of duty. Normally, that when in the manual system, when we say that one person is there who has to authorize another person to approve, and then the next person to make the payment, and then there are defined processes that this person cannot do this activity if it is conflict in the activities. Similarly, in the IT system, the segregation of duty is defined in such a manner that the conflict is erased out. The system itself throws, the conflict, and if those corrections are carried out in the system, then the conflict is erased out. But then whether those conflicts are actually being erased out in the system or not, and whether there any conflict arises in the segregation of duties concept in the ERP system, more to in the ERP system, or if the company is manual driven, then the manual system, let's say if the same person is making the purchase orders as well as making the payment to the suppliers, then it somehow gives a breach of duty, and then control system with respect to the the person is responsible for the purpose of the making the purchase order, and he's also responsible for the purpose of making the payment to the supplier, and then he's also responsible, let's say, for the purpose of making the books of accounts entry in the system. Then he can actually the company is vulnerable, the process is vulnerable, because one person can take the company the control system for granted, and can do any fraud or any kind of unauthorized transactions in the system. So those SOD conflict have to be seen whether they are system driven or they are manual driven. Then if in normally ERP system, one has to see whether the physical security of the server room, whether it's a weak access, not logged in, loose wiring, and all those stuffs. Activation, monitoring of audit logs in the system, that's very, very important. Now the law has been made that auditor also have to see that log system, and there is no I would say backdated entry is possible, or if there are any backdated entry, then auditor has to report. So that is one of the major point the auditor can see that while reviewing the auditor's log, whether the audit logs are there or not. In some of the companies, audit logs are there. There is a log, means the transaction done by, carried out by somebody in the system is recorded at which IT system or with which computer system has carried out this transaction. But whether the company has the policy of keeping those tables in the system, or they keep on periodically erasing those logs, that has to be seen. And if the logs are being removed by the company, then that gives a suspicion that any unauthorized entry might have taken place, which the company has carried out based on the unauthorized system. So these are some of the points deficiency one can find out from the IT system view. So once the IFC testing is carried out by the auditor, the auditor in a position, the auditor is in a well position based on the outcome of the design level testing as well as of the operating effectiveness testing, that how the control system with respect to internal financial control for financial reporting, how effective the control systems are there. The outcome of his reports may be having few deficiencies which are not material, which are rectifiable in nature, and which are one-off activity and not system-driven activity. So auditor has to assess, like the auditor which carries out the audit of a financial reporting system, they assess that there are many queries which are there, which they have found out in the course of their audit, and which query is material enough to be reported as part of the audit report, and which queries or which systems efficiencies are not as material, but they are yes significant, so that they are being reported to the board of directors or the audit committee. Similarly, for the purpose of the reporting, the auditor, for the purpose of completing the IFC report, has to also report the findings by way of whether unmodified report, like the report is clean, we normal way we call it a clean report, that the IFC is compliant with whatever company have designed is being found to be operative effectively, and they have designed properly all the processes, or there is a modified report. So there are two sets of report one can bifurcate. The unmodified opinion is the clean report, and the modified opinion. So we'll discuss in detail on both the aspects of this opinion. So unmodified opinion will call for effective IFC FR framework, and that's adequate and operating effectively. If it's a modified opinion, then modified opinion can relate to operating effectiveness of such controls or both adequacy and the operating effectiveness of such control. Then the auditor have to see whether the operating effectiveness is missing or is found deficient in some of the areas. Like the auditors may find that company did not have an appropriate internal control system for customer acceptance, credit evaluation, and establishing customer credit limit for sales, which could potentially result in company recognizing revenue without establishing reasonable. So let's say in this case, the process of evaluation of customers with respect to its credit soundness, with respect to its credibility is not robust enough. Hence, that is one of the deficiency in the IFC report. That system is not existence. Fine. So the auditors may give a modified reports. So modified reports means controls are designed, implemented, or operated in such a manner that it is unable to prevent or detect and correct material misstatement in the financial statement on a timely basis, or the control is missing, but effect or the possible effect of the material weakness in such internal controls are material, but is not pervasive to the financial statements. Means, although the process is not there, it is either not designed or it's not operating effectively. However, it is not pervasive in nature, in the sense that the control does not have effect on the other transactions of the company, on the other transactions which are not unrelated to, which are unrelated to this subject. So auditors may give the modified opinion in the IFC report. Then adverse opinion, where the auditors found that the controls either they are designed deficient or they are operating effectiveness deficient, and they are pervasive in nature. It means they are material, they are pervasive to the financial statements. So auditors can give the adverse opinion on the financial statements with respect to IFC FR. Now the example which can be taken is the company did not have an appropriate internal control system for inventory with regard to receipts, issues of productions, and physical verification. Further, the internal control system for identification and allocation of overheads to inventory was also not adequate. This could potentially result in material misstatement in the company's trade payable, consumptions, inventory, and expense account balance. Now, here the auditor is giving that these are the control weaknesses which may give rise to material misstatement in the trade payable, in the consumptions, in the inventory, in the expense, which is the part of the auditors of the main report. The auditor of the main report have to see whether the absence of controls or inadequacy of the controls at the design level or at the operating material level, coupled with the substantive testing which the auditor has carried out, gives the information which is not materially misstated or gives the information which may be materially misstated. If he finds that the outcome of the deficient control is giving rise to misstatement in the financial statement, or the auditor is not able to find out the material misstatement in the financial statement, then he has to give the counter, he has to give the audit report, qualified audit report with respect to the main audit report on the financial numbers. So here the IFC FR audit report gives an indication whether the controls are existing, whether the controls are found operating effective. Those controls which are not either designed or not found effective may give rise to a statement, may give rise to a situation which is materially misstated but not pervasive. That can go for modified opinion. If they are pervasive and materially effective, then it can give to the adverse opinion. So this is how an adverse opinion can be given, and there are various permutation combinations in the adverse opinion which the auditor may look into depending upon the outcome of the findings of this design level testing and the operating effectiveness testing. Then if he finds that the entire system is not established by the company with respect to internal financial control, or he is not able to find the sufficient appropriate audit evidences in order to perform whether the control system is existence or not, then he can give a disclaimer of opinion. So opinion can be unmodified, it could be modified with a material misstatement without having pervasiveness, modified with a material misstatement which is pervasive in nature, and then disclaimer, the statement or the controls which are not established by the company. So if the company has not established its system of internal financial control over financial reporting, considering the essential components of internal control stated in the guidance note, like the framework of IFC over FR is not established by the company as per guidance note. If that is the outcome the auditor finds out, then he may assess whether to give a disclaimer of opinion on the IFC FR. The auditor is unable to obtain, if the auditor is unable to obtain sufficient appropriate audit evidence to express an opinion, if he is not able to carry out his exercise of the review to opine on the IFC perspective, then also he has to give a disclaimer, or he may give a disclaimer of opinion in the IFC FR report. And when the auditor is unable to obtain sufficient audit evidence on which to base the opinion on the company's IFC over IFR, and the auditor concludes that consequent to the material weakness in such internal control, the possible effect on the financial statement of undetected misstatement could be both material and pervasive, then again he can give a disclaimer of opinion. So difference between adverse and disclaimer is that the company, in case of disclaimer, either has not established the system of control, or the auditor is not able to carry out the sufficient audit evidences based on his performance of this audit procedures. So then he can choose to give a disclaimer of opinion. So these are the issues which has to be ultimately find place in form of audit report, that is the deliverable of the auditing procedures. This I have mentioned, as part of the previous slides, that auditor will report if the company has adequate IFC at the balance sheet date. However, testing is carried out at the various intervals within the entire period of the audit, and is not carried out at the fag end of the audit year assess, because the process has to be prevalent, existent, and operating effectively in the entire financial year, and not only at the fag end of the year. However, if the company has found out has some deficiencies during the year, which the company itself has detected, or based on the auditor's recommendations on the interim financial statements review, the auditors finds out and flags to the company, and the company takes adequate due care in terms of fixing those design deficiencies or the operating effectiveness deficiencies. And at the later part of the year, the company is able to produce a proper compliant IFC FR, then the auditor may give choose to give a unmodified opinion on the IFC FR. These I have covered in pervasive or material weaknesses. So, for the purpose of giving a practical perspective, we have taken out a couple of listed companies, public listed companies. We have done analysis of 1,000 public listed companies, and some of the companies IFC FR report, is reproduced here without naming the company. So it's one of the power segment company carrying value of investments. This financial reporting IFC report says that material weakness has been identified in the company's internal financial control over FR on so and so date, at the close of so and so date, as regards evaluation of uncertainty for realizing the carrying value of investments or loan relating to so and so limited. So the process or the evaluation of carrying value, how the assessment is carried out of the carrying value of the investments or loans, that process is found to be deficient in terms of design or in terms of the operating effectiveness, or both. There is another company which has given a disclaimer of opinion due to possible effect on the matters described in the basis for disclaimer of opinion paragraph in our main audit report. We are unable to obtain sufficient appropriate evidence to provide a basis for our opinion on whether the company has adequate internal financial control over financial reporting with reference to these Ind AS financial statement, and whether such internal financial control were operating effectively. Accordingly, we do not express an opinion on the internal financial control over FR with reference to standard financial statement. So this is what one of the examples which we have taken, and one of the format which the institute has prescribed, that the auditor may choose to give a disclaimer of opinion if he finds that the design of IFC is not there, or he is not able to find out appropriate audit evidences. So this is a real example of a coffee chain where the disclaimer of opinion has been given. It's a public domain information which is reproduced over here. Then the company has mentioned that change in accounting policies and perspective given these as part of the modified report. Then is another company which is in manufacturing of specialty chemical. It has said that with reference to stock and inventory, the company needs to make its inventory management system, including physical stock taking process, more effective and robust. It means that the process which is designed for the physical stock taking is not adequate and not adequate and is not operating effectively. That's what the inference may be found out based on the qualification which is given in the report of IFC-FR. Then on physical verification of PPE of this by the same company, it is mentioned that the company needs to improve its process for conduct of physical verification of property, plant and equipment in phased manner at regular intervals. It means the auditor of this company has seen that the physical stock taking process of the inventory as well as of the PPE is not found to be designed appropriately as well as operating effectively. Similarly, we find that this petroleum products qualifications pertaining to the IT system implemented and monitored by the holding company. The company's computer systems and software are integrated with the entire group's IT infrastructure maintained centrally by the holding company. All system-driven processes and controls are devised, implemented and monitored by the holding company. The system audit report provided by the holding company covers the IT infrastructure of the holding company and not specially for the company. It means the auditor is giving its limitation in terms of carrying out the audit procedures with respect to IFC-FR on the ITCC and IT-related system controls, because the same are operated at the holding company level and to which he might not have been given access to. Now the question arises if the qualification or modified report or a disclaimer or an adverse opinion is given by the auditor on the IFC-FR portion, then whether the same report or similar repercussion has to take place in the main report, audit report, which talks of the true and fairness of the state of affairs of the balance sheets, the profit and loss account, and the cash flow of the company for the year under report. So a modified audit report or on IFC may or may not have the modified version of the main report. If the modified audit report is on some of the material item which is not pervasive in nature, and auditor based on the substantive testing finds out that the main substance based on substantive testing there is no risk of material misstatement, and he can skip from any modification in the audit report, and he can give a clean audit report to the shareholders. Or it may so happen that if he finds that the deficient design or deficient operating system operating effectiveness is giving rise to or has given rise to the misstatement in the financial statement or a potential misstatement in the financial statement, the auditors may choose to also mention the financial impact if he is able to find out, or he may mention that fact that he is not able to find out the impact of the financial misstatement. So like the process, like in one of the financial IFC-FR report, the auditor had mentioned that no process of physical verification of inventory at periodic level. That's what the report on IFC. It was an operative effectiveness, ineffectiveness as well as design effectiveness was there. However, when the auditors carried out themselves as part of substantive testing, and they found out that the physical stock did tally with the book stocks at various intervals based on their review, their independent assessment, or they have they got the independent professional chartered accountants or other professional report, and that gives a complete clarity that although the test is not being tested by the management, however when it is tested by an auditor, it is found to be effective. The auditor may not give the modified report for the inventory physical verification process in the main report, although he may give references in the CARO report. So there are three sets of reports: main report, CARO report, and the IFC-FR report. So if the IFC-FR report has any material weaknesses, it may find a replica or may not find a replica in the main report, whereas the CARO asks for certain specific questions, and if those questions are given answers in negative in the IFC report, then auditor have to also mention in the CARO whatever is being found out. So we have taken the extract of some of the public listed company, again 2000 listed clients. Some of the client we have mentioned over here is some of the companies we have listed over here, where the qualification in the IFC audit report found the similar qualification in the financial statement audit report. Like in this case, the power sector company says that evaluation of uncertainty for realizing the carrying value of its investments loan related to so and so limited, a wholly owned subsidiary aggregating so and so. So they are saying that process of evaluation of realization of the carrying value of its investments and the loans is design deficient or operating effectiveness deficient. Similar modification in the audit report has been mentioned by the auditors in the main report, which says that we have not been able to corroborate the management contention of realizing the carrying value of its investments and loans and advances aggregating so and so at the reporting date. Accordingly, we are unable to comment on the appropriateness of the carrying value of such investments and loans and advances and the consequential impact on the financial results. So we find that IFC report, if it is having a material pervasive or the item which has got a replica into this thing, then the financial audit report, FS audit report, can also be modified in the similar manner. In another company, supply of manpower, it says that the IFC report says regarding non-provision of possible shortfall in the value of assets of the provident fund trust managing the company's defined benefit plans for employees' provident fund obligation. So it says that the process is not found to be effective, and the similar qualification is given in the main report. Another case of a power company which says that investments made by a company were not carried out, which could potentially result in non-making provision in books against these investments, resulting in higher value of investments in books and higher statement of profit. And similar qualification on this on the item is given in the main audit report, which says diminution is temporary in nature, considering the intrinsic value of the asset, future prospects, and settlement of claims, whose impact is not ascertainable by the auditor. Another case of infrastructure company, which says that the provision of contract assets, which is outstanding for a substantial period of time, which could potentially result in company not recognizing a provision for the said assets, and we find a similar qualification in the financial statement audit. So we find that it is a judgment of an auditor based on the materiality, based on the pervasiveness of modified audit report in the IFC-FR, whether the same has financial impact in terms of the modified adverse / disclaimer report in the main audit report. Now, question arises whether this audit report on IFC-FR is applicable only on standalone or it is also applicable on the consolidated financial statement. So section is very, very clear. In fact, section 129 of 2013 states that provision of 2013 Act applicable to preparation, adoption, and result audit of financial statement of a holding company shall mutatis mutandis apply to consolidated financial statement. It means whatever provisions are mentioned for the purpose of standalone financials with respect to the auditor's responsibility, the same are applicable for the consolidated financial statement. So if it's a group reporting and there is a standalone audit report as well as the consolidated audit report, the auditor of a statutory auditor has to report on the IFC-FR portion of the standalone version as well as of the consolidated version. Then the next question arises that in case of consolidation of companies, whether they are joint venture or associates or subsidiaries companies, some of the companies are operating out of India. So whether, and maybe that, in their respective regimes, in their respective regulations, those IFC FR are not applicable. So how to deal with those companies, because the auditor also have not carried out the audit of those companies. The auditor has, done the consolidation based on the audit report of the corresponding auditors of the group company component auditors, whether they are the subsidiary company auditors or the joint venture company auditors or the associate company auditors. So how to go about that? So in that case, the law is very, very clear that applicability of IFC-FR on entity with respect to consolidation is only applicable on the companies which are incorporated in India. So auditors are required to mention that while giving the report on the consolidated financial reporting on the IFC portion, that they are limiting their FR IFC report only with respect to those group entities which are incorporated in India and not covering the companies which are outside incorporated, outside the country incorporated. Then some point with respect to IFC and internal audit. So although IFC reporting on the financial reporting financial portion is required to be reported by the statutory auditors, and internal auditors are appointed by the company, either an outside agency or they are in-house auditors. So there is no I would say substitution of IFC if internal audit has been carried out, because in-house internal audit, how effective and independent, that's a question one can see. Internal audit whether covered all the processes in a yearly cycle or more. So when we compare internal audit versus IFC, we find that internal audit may not cover all the processes in a year, and because normally in a large organizations, internal audit has a process life cycle which is more than a year. Then there are a couple of scope limitation in internal audit which are mentioned as part of the internal audit reports. In some of the places, financial transactions are covered, not taking chart of account approach, and how much is the seriousness of the senior management and the board of directors with respect to internal audit findings. However, internal audit has got its significance on IFC reporting, as financial issues presented in internal audit report provides easy gateway to IFC auditor about the state of affairs of the company. If internal audit reports carries certain deficiency in terms of design or in terms of control deficiencies in terms of operating effectiveness, the IFC auditor can get a very well bird's eye view in terms of knowing the state of affairs of the control environment in the company, and can plan and perform his area, his audit on IFC-FR perspective, taking the cognizance of the internal audit report. And significant issues may find place in IFC reporting if they are reported in the internal audit report. And scope limitation area, if he finds that internal auditor have given any scope limitation, he can also carry out any IFC audit planning. So internal audit, if it is existing in a company, it gives a comfort to a statutory auditors that about the control environment of within the company. However, he cannot just base his IFC-FR report on the findings of the internal audit report. It's a separate function which is a duty has been cast on the auditors to carry out an independent review of the financial transactions, internal financial control, and report independently of the internal audit. So he cannot take the shelter that since IA has given a clean sheet, hence IFC would also be clean. Now, in terms of CARO, I just made one differences. The scope of reporting in 2003 CARO, scope of reporting on internal financial control over financial reporting is significantly larger and wider than the reporting on internal controls under CARO. Earlier, the CARO was mentioning, before this IFC-FR came into place by way of 2013 Act of Companies Act. The CARO mentioned that the auditor have to report internal controls with respect to inventory or adequacy of internal controls over purchase of inventory and fixed assets and sale of goods and services. So only sale and purchase of goods and services and fixed assets was covered as part of the CARO report 2003 up to 2015, and this IFC is much larger in scope as well as in terms of its responsibility. In 2016, once this from 2015-16, IFC-FR audit report was applicable on each of the auditor of the company of listed and some of the private companies. Then internal controls was not included in the CARO reporting. In 2020, the latest CARO report, internal controls not included in CARO reporting. However, reporting pertaining to internal audit was added as follows: whether the company has an internal audit system commensurate with the size and nature of its business, and whether the report of the internal auditors for the period under audit were considered by the statute. So it gives a binding, or it gives a binding to the auditor that if there are internal audit which is there in the company, whether the auditor has taken cognizance of those internal audit reports while framing his audit opinion on the main report as well as on the IFC-FR question. So audit of IFC-FR, as we have seen right from planning stage to the conclusion stage, it should be combined. The audit of financial statement as well as audit of FR has to be seen in that tandem. And objective of the audits are not identical, although, however, the auditor must plan and perform the work to achieve and the objective both the audit, because each activity complement to the other part of the activity. If the controls are sound as per the IFC-FR report, then the outcome of the financial numbers, there are chances that it will also be correct. So we have covered the IFC part. Now I will be touching upon a few points on the implementation guide on the audit of IFC over FR for specific reference to smaller and less complex companies. Now to give a brief overview, since I was part and parcel of this team which produced this guidance note or implementation guide. Once we see that IFC guidance note which is issued by the ICAI in 2015, it's a very, very comprehensive document covering close to more than 250 pages and giving a detailed description of how a control to be designed, how SOPs, various risk control matrices has to be defined by the company, and how they have to be tested by the auditor. And in the absence of these documented processes, the auditor may assume based on his own assessment of the controls environment whether the company has really prepared those IFCs in line with the guidance notes or not. And if not, then the auditors can give a modified report in its audit opinion. So it's a very, very detailed structure. So the need was felt that this detailed guidance note, which is running into more than 250 pages, is mainly covering to the companies which are having large operations, having complex operations, running into ERP system, integrated approach, and they are having operations may not be only in the country, but their operations are spread across the continents or across many countries. So if there are companies, large number of companies which are there, which are very small in nature in terms of size, although the size in terms of volume is not defined in the guidance note implementation guide. So they mentioned that the company which are smaller and they are less complex, they do not have many layer of management, they do not have the complex ERP system, they may not have many people to operate upon. So segregation of duty is not as one can find in large companies. So how to go about the IFC? Because initially, there is one point which I just want to mention, by putting a preface to this scope, that initially in 2015-16, the financial year from where this IFC was applicable for the purpose of reporting by the auditor, it was applicable for all companies actually. So there was no bifurcation of a small company or a large company. It was applicable on each and every company, irrespective of its size, nature, and complexity in the business. Then later in 2017, the company law has amended that particular section, and that's it. Then it has taken out few companies like 1% company or company having a turnover or criteria 50 crore rupee or a loan of 20 crore rupee, something of that sort, which may not be required to carry out the this IFC reporting by the auditor. Although from the company perspective, they are required to make sure that complete IFC is there and being implemented, but auditors were not required to comment on the structure as well as a part of separate. So need was felt to take care this particular subject, what to do with the smaller companies. So just I have mentioned, the question, because we debated a lot how to go about it, and then ultimately it was decided by the committee that let's have a FAQ kind of questionnaire, and then we can give the answers to some of the question, some of the point. I'm just going to pick it up because time is short now. I have only 10-15 minutes left out. So control environment may not be available in documented form. Now, small company, which is having turnover of 10 crore, 50 crore, 100 crore, maybe 200 crore, and only having a trading operations, let's say, or having a very small manufacturing assembly line operations, and the senior management and the owner are same. There are not many layers of the operating management, middle management, and the junior management, and they are running on a manual system or on a very small, I must say, accounting system, which is not integrated, which is not ERP kind of system. So company may not be able to document each and every document, each and every process. So how to go about? Because the disclaimer opinion says that if you find that the IFC is not designed by the company, then one can give disclaimer of opinion. So in the small company, how the auditor would go, because he knows for sure that it is not practically possible for the company to have a detailed version of SOPs and the risk control matrices and the complete design which is prescribed as per the guidance note. So answers to his questions were given in the implementation guide. That it is not necessary that everything has to document it. The auditor, while he carries out the audit of those companies, he can see from the perspective of checking that whether the controls are effective or not, whether they may not have been, they are not designed, they might not have been designed in the piece of paper, but they are operating effectively, hence they are designed. Because it is the verbal description which might have given might have gone from the side of the owners to the operating management. So not having a documented form of the SOPs and RCMs, not having a very elaborate IT general control testing may not give rise to kind of qualification unless and until auditor has reasons to believe that the control system for the purpose of testing of controls or design deficiencies, he really finds there is a big gap which can give a material misstatement in the books of accounts. So I just want to say, basis this implementation guide, which is applicable to many more companies, not only for smaller company, that absence of a documented policy by the company on some of the aspects of the IFC may not give rise to a conclusion by an auditor that things are not correct. He has to see the practicality of the situation. He has to assess the control environment based on the discussion with the management, interview process, and going through the documents, going through the circulars, the IOMs and other stuff which is available, which may not be very comprehensive in nature, but that gives rise to a kind of satisfaction to an auditor how the control system is prevalent in the organization. So this is what the crux of this implementation guide on smaller, less complex company, which is to my knowledge equally applicable to large company, because it is not possible that every company would have a very detailed SOPs and very detailed RCM in each and every aspect of the process, of the business processes. Some of the business processes which are added during the year might not have been given effect to in by way of the detailed SOPs and detailed RCM, but it is an auditor or the management. The management has to assess that although there is no documented designed SOPs and RCM, however the process is similar to what should have been there assessed, and the auditor should also see from that perspective in order to give an assurance or find that things are and assess the control environment accordingly. So the last portion of my presentation is a few takeaways, common myth about IFC. I hope I have been able to deliberate the concepts and other aspects of IFC. So there are certain common myths based on practical scenarios. Once we are in audit and we carry out audit, we find that by the management, which are large. Now I'm not talking of smaller companies. I'm talking of companies which are large enough, having multiple layer of management and various operations spread across the country or maybe more than one country, and they're having manufacturing, trading, services, and they're large in terms of the turnover or the size of the financials. So some of the companies say there is no need to document process and controls. That's not correct. These are myths. We don't need to link risk and controls. That is also not correct. Although companies may not have the RCM as a RCM, but they may have some other document which shows that those risks are mapped to the control. Because unless the company are able to have documented documented evidences of the mapping of the control with the risk, how would the management carry out its own assessment and give a certification to the board of directors about the effectiveness of design as well as of the operating effectiveness. So these are common myths. Testing of controls and evaluation of deficiency is the responsibility of the auditor. That's not there, as the law has very clearly demarcated the responsibilities of the management, the responsibilities of the board of directors, the responsibility of the audit committee, and as well as of the statutory auditors. So it is not that it is the auditor only who has to test the design level as well as operating level of the effectiveness of the control system. It is the management which has to give it first assurance and first go ahead that everything is fine, and then the auditor can test and can based on his independent testing can see to it the fate of the audit report on the IFC. So we don't need a process for IFC certification to board AC. We know people are doing it and exceptions are identified by auditors. Meeting CARO requirement is sufficient. We don't need to revisit processes and controls. We have a good SLAs like service level agreement with service providers. We don't need to evaluate their control. That's not correct. Many organizations have outsourced a lot of their operations, and we find that in large companies the payroll is outsourced. Sometimes the complete revenue cycle is outsourced. Sometimes we find even the supply chain management is outsourced, and the company would have an SLAs with the service providers. But those SLAs are basically an activity linked paper that what to do, when to do, and how to do, who has to do. They may not have the controls and the risk mapping, on those SLAs, because if the operations of the company are being outsourced and they are being performed by some service provider, so those processes also need to be tested from the IFC-FR perspective in order to give an assurance to an auditor, reasonable assurance, whether the controls are effective or not. So SLAs cannot replace unless and until they have an integrated risk control matrix, aligned to it. But normal SLAs, which are more contextual in nature, may not be able to substitute the complete RCM and the SOPs. So there is not much difference between the process and control. That's not correct. Materiality is for the financial. It does not really impact control consideration. We have internal audit, no need of IFC. We understand controls. There is no need of training and development of our people. That's not correct, because based on the changing environment in the various, the controls also keeps on changing. Some of the processes which were operated manually by the management, over time they are automated. So control needs to be seen and reviewed and then refreshed. So those training, development, as well as continuous improvement must take place in those controls environment also. Automation through ERP controls are automatically in place. So that's not also sometimes correct. We find, based on our practical exposure, we find that many companies which are working either on SAP, Oracle, or Navision, or many more other similar ERP packages, although they have the complete reporting is coming out from the SAP, but we find that once you go deeper in the system, we find that the controls are, those SAPs and Oracles are being used more of a processing of information rather than the processing of the flow of transactions. And a lot of places the maker checker breach happens. A lot of places the super user is able to exercise many transactions which should have been routed through a proper internal controls system. So just because company has an ERP doesn't mean that that everything is hunky dory in the company. It really requires, rather it more requires in order to see whether the the control mechanism, the control environment on the financial side is operating effectively or not. We don't need an oversight body to oversee all changes in the process. Some of these myths have to be seen, and management has to be convinced that yes, they require documented policies, they require documented risk control matrices, they require a periodic updation of their controls. I would say risk register we call it, and ERP does not substitute the controls, and has to be seen in that perspective. So last leg of my presentation, which will last for next 5-10 minutes, 5 minutes or so. Some takeaways, practical aspects based on the auditing of statutory audit. I would say for last more than 2 decades. So as I mentioned, that chart of accounts plays a very important role in devising the audit plan for the IFC. We find that many places, even the seasoned auditors have their own whims and fancies that we know the system, and we know how to make the audit planning, and they overlook the chart of accounts. And sometimes it is noticed that many non-recurring heavy volume and value transactions might have taken place, which are not found in the designed audit planning document. So that case has to be seen, that chart of account approach must be adopted while devising the plan for audit of IFC. Although I have covered in detail in the planning part, at the same time I wanted to make sure that significance of this item is too high and must be given due importance. So that is what. Then IFC of 1 year may not be the same of subsequent year, because as the environment of various changes, as the transactions changes, non-recurring transaction may take place. Some of the controls which were effective in the previous year might not have been effective in the subsequent year, or vice versa. It may so happen. So one cannot rely that last year they have checked it, so hence this year the IFC FR may not be required in the same I may say rigor. ERP, I mentioned, misnomer in many organizations. Instead of process flow as defined the system, actual processing may be an eye opener. So somebody, a smart auditor, if he goes and finds out that after the transaction has happened, they are just processed by the people which are designing the system, and so one has to see that it's a manual control which is effective, or automated control, or the ERP control which is effective. That's what need to be seen. We have seen use of super user ID and generic IDs. We find that a lot of generic IDs are being used in the system, because these packages, ERP packages, sometimes are too costly to management. Some management in the initial year, they may not take number of licenses which are required for the for the complete process, and a lot of processes are routed through the generic IDs, so which compromise the control aspects. Has to be seen in that perspective. Unless and until the auditor carries out a detailed ITGC review and application control review, this aspect may not be seen, and then control might get missed out. Then sometimes we find that key business processes such as purchases, sales, capex, treasury to a large extent, capex to a large extent, where key controls and processing of transactions lies in the hand of one or few senior management end to end. So we find that people would say no, it is signed by the MD, or it is signed by the let's say senior management, so it does not require any other review. That's not correct. At every level the review is required, and just because it is having this nature of a senior management does not mean that the due process might have been carried out. So one has to see from that perspective whether the proper control system which are defined as part of the SOP are are being effective. Although they are designed properly, but they may not be operating effectively, because. And when we find that people say that it is signed by senior management, hence you should not raise any query, that may not be a correct version. So one has to see from that perspective that this control system has to be evaluated, not with respect to the person who is signing it, with respect to the process and the due procedure which should have been followed. Related party transaction, many reports which we have found out of 1,000 listed company. We found that many places or many reports have the modification in the IFC FR report with respect to related party transaction. It is too difficult to evaluate. Specific focus on complete chain of process, authorization, mechanism, recording, and all those stuff. So related party transactions plays a very significant, aspects and portion of the entire IFC-FR perspective. And sometimes we find that, many transactions are routed through, related party, which may not, pass the test of proper control system with respect to negotiation, with respect to, proper evaluation of credentials of parties and things of that nature. So that has to be seen, from a critical aspect. Then high financial impact, non-routine transaction. I have mentioned that, non-routine transaction sometimes the one can really, map it based on the chartered account approach. General vouchers, again, non-routine transactions can take care. Then selection of parties for the PPE, whether they are, proper evaluated with respect to credentials of parties. Then sale of PPE item, sometimes we find that without following due process with respect to approval mechanism, independent technical evaluation, how much it may fetch, just because 3 quotations have been taken and basis that, one is able to effect those directions. One auditor have to put his special focus in case of, large value item of sale of certain PP items, whether proper technical evaluation by the management is carried out with respect to what should be the right price, what should be the right, I would say parties to be called for the purpose of negotiation and all. So these are some of the aspects, which has to be seen. So this is all from my side. I must thank, again, WSP board, and I hand it over to moderator, chairman of Sonipat branch of NIRC, CA Varunji. Varunji. Varunji, you are on mute. If you can.
Okay, sorry. Thank you, Yogeshji, for the wonderful deliberation. I will say it a complex topic simply explained.
Thank you so much.
And I hope all the members, all the participants will surely grow after listening to this session, and they will be able to solve the queries or the dilemma which they might have faced during the audit of this internal financial control audit. Sir, there are some questions which have been received from our participants. If you allow me, I'll
surely
take it one by one.
I would love to.
So the first one is how to evaluate aggregation risk in case of GITC failed. Can ET reply on manual comments? What steps needs to be performed?
Can you repeat this question?
I'm repeating, sir. How to evaluate aggregation risk in case of GITC failed?
GIT failed. I'm not able to understand what is.
Can ET rely on manual control? What steps need to be performed?
So I have explained in detail in my presentation, which I'll also share as part of this thing, which you can populate to the member at large. That one has to see the IDGC controls, and then if they find that IDGC controls on any aspects are not adequate enough, even the application control on the IT side is not applicable enough, not adequately maintained enough, then one can switch to the manual control, because substantive procedure has to be found out, has to be carried out in order to assess whether the transactions passes the financial FR, the IFC FR or not. That's very, very essential. It's not just because IT has failed, hence I will say that the IFC report is read. One has to do the substantive testing and carry out the manual test in case you find IT is not moving. That's what is also mentioned in the smaller, less complex company implementation guide. Very detailed, in 2-3 questions we have answered this thing that is very, very relevant for the purpose of understanding that IT is not the entire subject. One can always see from manual perspective, and then one can see that it is not IT related control, it is manual control. The effort is more, and number of transaction has to be seen, has to be taken. I think more than what anybody would have taken for the IT controls.
Okay, sir. And next question is, sir, what exactly internal financial control consists of?
Policies and procedures, I would say in each of the business segment, and as I mentioned in my presentation, it is having the entity level, the code of conduct, the whistleblower policy, the ITCC, the internal audit mechanism, the oversight of board, independence of internal auditors. These are the aspects, and then the process level controls with each of the business function, whether it is purchase to procure to pay, whether it is O2C, whether it is treasury, forex, and something. So each and every business function based on the chart of account has to be mapped and then seen from that perspective.
Next question is whether CA has mandatory obligation to check valuation method accepted by a company for stock in hand are correct or not selected. Who is responsible if valuation method for hardware of information technology if selected weighted average instead of FIFO basis?
This is more of an accounting question, not an IFC-FR question, but I would say that one has to see what is the accounting policy of the company, whether it's on the FIFO basis or weighted average basis. And because accounting policies, they are prescribed as part of the accounting policy and they are presented in the financial statement. And if the financial statement accounting policy says that has to be seen from the weighted average, then the accounting and the valuation has to be done based on the weighted average. And if it says FIFO basis, because both the methods are applicable as per India's too. But it is not possible, it is not correct, if we write in the management rights in the accounting policy that they are doing on weighted average basis, whereas they carry out on FIFO basis. That will be wrong. So IFC will also be read as audit report will also be read.
Okay, sir. Sir, the next question is it mandatory to company to keep data of UTR of NEFT and RTGS payment in accounting software while doing payment to outsider party? If company do not keep right UTR number in accounting software, will it be say audit trail compliance fail?
Look, audit trail has recently been launched from this year itself, but I can say for sure that UTR is automatically traced by way of bank statement. So whatever transaction we are making through IFC mode or UTR mode, because bank statement would capture entire transaction, entire gamut. So company may not require to have the separate recording of those transactions. They are being recorded by the banks in any case. And nowadays everything is being mentioned. Whether they are on piece of paper or on soft form, the complete transaction trail is there. Even if you make a small payment through Paytm, it gives a complete reference number, IFC number, UTR number, and the date, time, everything it gives. So that log is already created in the system. One just need to preserve it for the purpose of audits.
Sir, next reader is asking, while passing credit note in SEP B1 version, what will be sporting required for this on regards to audit trail compliance?
For passing a credit note, in a SAP version, I may not know what B1 version is, but in SAP or any ERP package, if somebody is passing a credit note for this thing, one has to find out the basis of that credit note. It is either linked to my incentive scheme, like the company would make sales first, and then after the passage of time, when they say you are eligible for this quantity discount or this volume discount or this cash discount. So if it is backed up by any of the incentive scheme of the company, then that is the basis one has to mention. And normally in ERP system and SAP system, these are auto calculating. There is no requirement of because you have to upload the scheme. You have to upload already the revenue is uploaded. It automatically calculates and then gives you the number. You just have to press the button and make the entry.
Sir, next question is whether comment on the audit trail is required under IFC-FR.
So that is I think the first year is going to happen from 23-24, and the government is going to come out with the complete perspective, because IFC-FR in itself, there is a complete audit report. So whether that complete audit trail is to be mentioned as part of the main audit report or CARO report or IFC report, probably I have not gone through that perspective or might not have come into play as of today. But that will be, as per the regulations. Well, nobody can make any guesswork based on his own this thing. It has to be based on what the regulation would prescribe for that.
Sir, next is I would like to know how IFC is different from the financial controls which are part of the internal audit. If both are the same, is this just attaching the responsibility?
No, I would say, I have covered in detail this internal audit concept and the IFC portion. If you have seen that presentation was there, internal audit and IFC both complement each other, but IFC internal audit is not substitute to IFC. IFC is mandated for statutory auditors to comment because he has a bigger responsibility than the internal auditor, because he is also reporting on the financial numbers, the entire balance sheets in the profit and loss account and the cash flow he's reporting upon on. Fine. Internal auditor may carry out the entire transactions in a year, or he may spread it in more than 1 year. The scope of the internal auditor is dependent upon what management or what board of directors would define for internal auditor. Fine. Where the scope of statutory auditor is already defined as per the Company Act. You cannot say that I will pick a purchase next year, hence the purchase reporting of the audit report I will make next year. The entire transactions which has taken place during the year have to be reported by the statutory auditors. So internal auditor, in terms of volume, in terms of value, in terms of independence, internal auditors, most of the company would have their own internal department. Fine. How independent that internal auditor is. An IFC auditor, because he's a statutory auditor, so he has a responsibility and then he has an authority. If he finds something amiss, he can always put it in form of an audit report. So internal audit cannot be replaceable with IFC or the vice versa for that matter. Both are independent functions, and internal auditor's report, yes, are taken into consideration by the IFC auditor. And if internal auditor finds any major loopholes in the functions of internal control on financial side, the IFC is bound to take that report and accordingly plan his audit.
So next question is, what is the criteria to determine whether the design of control is adequate and meets the requirements of IFCFR?
So that is a very good question. I have mentioned in the presentation itself that after the planning and the risk assessment stage is completed, then the next step is design level control assessment. Design level assessment implies that one has to find out what is the complete transactions, the flow of the transactions, and each of the portion of the transaction, the auditor or the management has to see that design is properly adequately covered. Like in case of procurement, I mentioned that that example, the right from the purchase acquisition to the purchase order, calling of the quotations, negotiation with the suppliers, finding out the credential of the suppliers, and moving to the receipts and payment to the vendor as well. There is a complete trail as such. So design level has to be seen from that perspective, and then operating effectiveness has to be seen after design is checked up.
So if the auditor reports that he finds certain controls or all controls are inadequate or do not exist, then what does he report on reliability of financial reporting?
So that may call for a disclaimer of opinion. That's what one of the format of audit report. Audit report has got an unmodified version when everything is fine. Then there is a modified version when he finds some material misstatement. Then there is a adverse report, and then there is a disclaimer of opinion. If he finds that control system is totally non-existent, or he is not able to carry out any control assessment, then if he finds that there is a complete breakdown in the system, then he has to give a disclaimer in the IFC, and that disclaimer has to be seen from the main audit report, because if these controls are not there, maybe that the complete transactions might not have been reported, and balance sheet and profit account might not present the complete true picture. So that has to be replicated probably in the main report.
Okay, sir. And sir, last question is whether any correction made by auditor in inventory valuation or revenue recognition will lead to qualification in ICFR report, also even if adjusted by the client in the financial statement.
To my knowledge, no. If it is not, first of all, material, it's one of the transaction, or the management or the operating people who are controlling or managing their affair might not have that kind of knowledge, or they have skipped it, because as part of audit process, when we carry out the audit, we find many mistakes which have been happened, by the company, whether it is the cutoff procedures, revenue is recognized, after the 31st of March, let's say, or some inventory valuation process is wrongly captured. So it is the process of, first giving the issue sheet to the management and then informing them these are not correctly. Management may carry out those correction adjustment. If the adjustment is not material amount, which give rise to the, any qualification in the audit report, then those can be skipped as such, because adjusted numbers are reported in the balance sheet and the profit account, and the auditor is also satisfied that there is a complete control mechanism which is existing and management has taken due care So that it does not require to be reported unless it is material.
Okay, sir. So, sir, questions are now over. So, I will request Anilji if there is anything pending from our side, sir. Otherwise,
No, sir. All questions are over, sir.
okay, sir. I'm thankful to CA Yogesh Gupta ji again, sir. And I hope that this session, the basic session and the question answer session, the query session, which have been taken after the basic session, it will resolve all the doubts created in the mind of our participants, and they will. And this session will help to clear all the pending dilemmas in their mind. Now, I am also thankful to the organizing committee and our chairman, CA Dr. Sanjeev Singhal ji, for providing me opportunity to connect with you all and moderate this session. Now, I will request Anil ji to kindly thank Yogesh Gupta ji for the seminar.
Thank you so much, sir. Thank you so much, Yogesh, sir, for such a wonderful and detailed deliberation, sir. Hats off to you, sir, for the whole 2 hours you have spoken on the topic, and you have covered all the aspects of auditing aspects of internal financial control, and you have explained in a very detailed and lucid manner. So I have gained a lot through your deliberation. Hope our members have also gained a lot through your deliberation, sir. Thank you so much on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India for sparing your valuable time and enlighten all of us on various intricacies or the various audit considerations on internal financial controls. I'm also thankful to the Honorable Chairman of Sonipat Branch, CA Varun Vatsi, for sparing your valuable time and for co-hosting this webinar, as well as the moderating this webinar and sparing your whole 2 hours with us and interacting with the speaker. Thank you so much on behalf of AASP of ICS. Thank you so much, sir. Thank you so much, Yogesh, sir. Thank you so much, Varun, sir.
Thank you.
Thank you so much.
All.
Thank you, sir. Namaste. Namaste.
I am logging it out.